The year was 2018. It was a year that would mark the beginning of a significant shift in global trade dynamics. Donald Trump, then President of the United States, launched a series of tariffs on Chinese goods. These tariffs were part of his administration's broader strategy to address what they saw as long-standing trade imbalances and unfair practices by China. This marked the beginning of a trade war that would have far-reaching consequences for both nations and the global economy. The initial tariffs were just the opening salvo in a conflict that would escalate rapidly. Trump's stated goal was to protect American jobs and industries from what he perceived as unfair Chinese trade practices. He believed that by imposing tariffs he could level the playing field for American workers and businesses. These included allegations of intellectual property theft and forced technology transfers. The administration argued that these practices were costing American companies billions of dollars and stifling innovation. China, however, viewed these tariffs as a direct attack on its economic rise and responded with retaliatory measures of its own. The Chinese government was quick to impose its own set of tariffs on American goods, signaling that it would not back down easily. The initial volley of tariffs targeted billions of dollars worth of goods flowing between the two economic powerhouses. This tit-for-tat approach quickly escalated, affecting a wide range of industries and products. The U.S. imposed levies on Chinese products ranging from solar panels to washing machines. These tariffs were designed to hit key sectors of the Chinese economy, putting pressure on Beijing to change its trade practices. China countered by slapping tariffs on American exports like soybeans and pork. These agricultural products were crucial for many American farmers, who suddenly found themselves caught in the crossfire of a geopolitical struggle. These agricultural products, crucial for many American farmers, became pawns in a high-stakes geopolitical chess match. The impact on the farming community was immediate and severe, with many farmers facing financial uncertainty. The world watched with bated breath as the trade war escalated, casting a long shadow over global markets. Investors and businesses around the world were left to navigate the uncertainty and volatility that came with each new round of tariffs. As months turned into years, the trade war intensified. The tariffs imposed by both sides grew larger and encompassed a wider range of products, affecting everything from consumer electronics to industrial machinery. The tariffs imposed by both sides grew larger and encompassed a wider range of products. Consumers began to feel the pinch as prices for everyday goods started to rise, adding to the economic strain. The initial skirmishes gave way to a full-blown trade conflict, with no clear winner in sight. Diplomatic efforts to resolve the dispute were ongoing, but progress was slow and fraught with challenges. Businesses on both sides of the Pacific felt the pain, facing increased costs and disrupted supply chains. Many companies had to rethink their strategies and supply chains to adapt to the new trade environment. Consumers, too, were not immune to the consequences, as prices for everyday goods began to rise. Trade war had a ripple effect, impacting households and businesses far beyond the borders of the US and China. The trade war had become a lose-lose proposition, harming both economies and fueling global economic uncertainty. As the conflict dragged on, it became clear that there were no easy solutions, and the world would have to brace for the long-term impacts of this economic showdown. China's retaliation against U.S. tariffs was swift and calculated. The Chinese government didn't just react impulsively, they meticulously planned their countermeasures to ensure they would hit the U.S. where it hurt the most. And strategic. The Chinese government carefully selected targets that would inflict maximum pain on the American economy while minimizing damage to its own. This strategic approach was evident in the sectors they chose to target. Among the hardest-hit sectors were agriculture and automobiles, two pillars of the U.S. economy. These industries not only represent significant portions of the American GDP, but also employ millions of workers across the country. By targeting these industries, China aimed to pressure the Trump administration to back down from its aggressive trade policies. The hope was that the economic pain would translate into political pressure. Soybeans, a major American agricultural export to China, became a primary target. This was a calculated move, as soybeans are a critical component of the agricultural trade between the two nations. China was, at the time, the world's largest importer of soybeans, using them primarily for animal feed. The demand for soybeans in China was immense, driven by its large livestock industry. The U.S., as the world's leading soybean producer, had been a major supplier to the Chinese market. American farmers had long relied on this trade relationship to sustain their livelihoods. However, with the imposition of tariffs, China drastically reduced its soybean imports from the US, turning instead to alternative suppliers like Brazil and Argentina. This shift had a ripple effect, impacting global soybean markets. The automotive industry was another casualty of the trade war. American car manufacturers, who had invested heavily in the Chinese market, found themselves at a significant disadvantage. China imposed a 25% tariff on imported cars from the US, significantly increasing the price of American vehicles in the Chinese market. This made it much harder for American cars to compete with local and other international brands. This tariff had a profound impact on major US automakers like Tesla, Ford, and General Motors, which had been betting on the rapidly growing Chinese car market to boost their sales. These companies had to quickly adapt to the new economic landscape. The tariff made American cars less competitive, forcing these companies to rethink their strategies in China. They had to explore new ways to maintain their market share and continue their growth in the face of these new challenges. American farmers, particularly those in the Midwest, bore the brunt of China's retaliatory tariffs. The soybean industry, heavily reliant on exports to China, was devastated. Before the trade war, China had been the largest market for American soybeans, importing over 30 million metric tons annually. However, Chinese imports plummeted after the tariffs were imposed, falling to less than half their pre-trade war levels. This sharp decline in exports created a glut in the US soybean market, driving down prices and leaving farmers struggling to make ends meet. Many farmers had taken on significant debt to invest in their operations, and the sudden loss of a major market made it difficult to repay their loans. The Trump administration offered billions of dollars in aid to farmers caught in the crossfire, but these payments did little to offset the long-term damage inflicted by the trade war. The plight of American farmers illustrated the high cost of the trade war. These farmers, many of whom had supported Trump's policies, found themselves on the front lines of an economic battle that seemed to have no end in sight. The trade war highlighted the interconnectedness of the global economy and the unintended consequences of protectionist policies. Section 4. American automakers on the defensive. A 25% hill to climb. The 25% tariff on U.S. cars imposed by China dealt a significant blow to American automakers. China, the world's largest car market, had been a key target for growth for companies like Tesla, Ford, and General Motors. These companies had invested heavily in expanding their presence in China, hoping to capitalize on the country's burgeoning middle class and increasing demand for personal vehicles. The tariff, however, upended their plans. The increased cost of American cars made them less competitive compared to domestic Chinese brands and other foreign automakers that manufactured their vehicles within China. As a result, sales of American cars in China slumped, forcing U.S. automakers to adjust their strategies. Some companies chose to absorb the cost of the tariff, reducing their profit margins to maintain market share. Others raised prices, risking a further decline in sales. The tariff also accelerated a trend of U.S. automakers shifting production to China to avoid the levy. This move, however, drew criticism from those who argued that it would lead to job losses in the U.S. The trade war presented American automakers with a difficult dilemma, forcing them to make tough choices in a rapidly changing global market. Section 5. The ripple effect consumers caught in the crossfire. While the trade war initially targeted specific industries, its effects soon rippled throughout the U.S. economy, impacting consumers in various ways. What began as a series of tariffs on select goods quickly expanded, touching nearly every sector of the market. The interconnected nature of global trade meant that even industries not directly targeted by tariffs felt the strain. One of the most noticeable effects was rising prices for consumer goods. Shoppers began to see higher price tags on everyday items, from groceries to household essentials. This wasn't just a minor inconvenience. For many families, it meant making tough choices about their spending. The tariffs imposed on Chinese imports raised the cost of production for many American companies that relied on Chinese components or finished goods. Factories that once operated smoothly found themselves grappling with increased expenses, which inevitably trickled down to the consumer. These increased costs were then passed on to consumers in the form of higher prices. The checkout experience became a source of anxiety for many, as they watched their total climb higher than expected. From electronics and appliances to clothing and toys, a wide range of products became more expensive for American shoppers. The impact was felt across all demographics, but particularly hard hit were those who were already struggling to make ends meet. The price increases varied depending on the product and the extent of its reliance on Chinese manufacturing. Items with a higher percentage of Chinese components saw the steepest hikes, while others experienced more moderate increases. Still, they placed an added burden on American households, particularly those with lower incomes. For these families, every dollar counts, and the rising costs meant having to cut back on other necessities or forego certain purchases altogether. Beyond rising prices, the trade war also contributed to supply chain disruptions. Shelves that were once fully stocked began to show gaps, and certain products became harder to find. American companies that relied on Chinese suppliers for components or finished goods faced delays and shortages as the tariffs slowed down the flow of goods across the Pacific. This not only affected the availability of products but also led to longer wait times for new stock to arrive. These disruptions forced some companies to find alternative suppliers, often at a higher cost, further adding to inflationary pressures. The search for new suppliers was not always successful, leading to further complications in the production process. The trade war's impact on consumers highlighted the interconnectedness of the global economy and the far-reaching consequences of protectionist trade policies. It served as a stark reminder that in a globalized world, actions taken in one country can have profound effects on consumers and businesses far beyond its borders.